So you own stocks and you think we're in a bull market. Well, I have a surprise for you. This could be a dead cat bounce. A dead cat bounce is a financial term used to describe a temporary recovery in the price of an asset, usually a stock, after a sharp decline, but which ultimately proves to be short-lived and followed by a further decline. Today, I'm going to be talking about a topic that's very important for anyone who's currently holding stocks or thinking about investing in the market. We all know stocks are for investing in the future potential growth of a company and potentially generating a profit for the investor. But what if the market corrects or pulls back? You may end up losing money and regretting owning stocks or investing in them to begin with. The current situation in the market can be unpredictable and dangerous, especially when the Federal Reserve decided to raise interest rates. An increase in interest rates can cause central banks to lose money and result in a bank run. This was the case for Silicon Valley Bank, which was the largest bank by deposits in Silicon Valley and the preferred bank for almost half of all venture-backed tech startups. In March 2023, after central bank endorsed interest rate hikes, there was a bank run on its deposits. And this led to a collapse and seizure by the California Department of Financial Protection and Innovation. State officials cited inadequate liquidity and insolvency and appointed the FDIC as the receiver of the bank, marking the second largest bank failure in US history. However, depositors were fully protected and the FDIC established a bridge bank successor, Silicon Valley Bridge Bank, NA, which assumed ongoing business. The situation highlights the importance of diversifying one's investments and being prepared for market fluctuations. The Fed balance sheet plays a crucial role in controlling and managing interest rates, and the assets and liabilities it holds can have significant implications for the economy and your portfolio. The Fed's balance sheet is a tool they use to control and manage interest rates, and the assets and liabilities they hold have ramifications for the economy. For the last 15 years, the Federal Reserve has made money off of their balance sheet, but now they are losing money due to their own policies. As a result of raising interest rates, the Fed is paying more in interest to banks than it is receiving in interest on their assets. This means the Federal Reserve is now making a loss instead of a profit and will have to create an IOU to pay themselves back later. This situation will lead to the Treasury having less money and they will have to take on more debt to add to the deficit. Although the Fed's day-to-day operations are not expected to change significantly, the management of its losses is a new challenge that they must face. This instability could potentially cause uncertainty in the market, making it a dangerous time for investors. If you hold risky stocks, it's only a matter of time until you see a big pullback. Let me repeat myself. This is going to be pretty much the most important video that you can watch because protecting yourself is as important, if not more important, than making money in the market. During the dot-com bubble, many internet-related companies experienced significant growth and saw their stock prices soar to unsustainable levels. However, when the bubble burst in 2000, many of these companies went bankrupt or saw their stock prices plummet. Here are a few examples of stocks that never fully recovered from the dot-com bubble. Number 1, Pets.com. Pets.com was an online pet supplies retailer that gained popularity during the dot-com bubble. However, the company struggled to turn a profit and went bankrupt in 2000, just 9 months after its initial public offering or IPO. Number 2 stock was Webvan. Webvan was an online grocery delivery service that aimed to revolutionize the grocery industry. However, the company was plagued by high costs and struggled to gain a foothold in the market. It went bankrupt in 2001. Number 3 is WorldCom. WorldCom was a telecommunications company that grew rapidly during the dot-com boom as well through a series of mergers and acquisitions where companies merged together or buy one another. However, the company was later found to have engaged in accounting fraud, which led to its bankruptcy in 2002. While some of these companies that I mentioned may have re-emerged in different forms, their original stock prices never fully recovered from the dot-com bubble. The examples of stocks that never recovered from the dot-com bubble illustrate the risks of buying the dip strategy. which involves buying stocks after a price drop in the hopes that they will recover and increase in value. During the dot-com bubble, many investors were caught up in the hype surrounding internet-related companies and bought stocks at inflated prices without fully understanding the underlying fundamentals of the business. That's why I always teach using fundamentals and technicals when trading. While there may be times when buying the dip can be a successful strategy, such as when a company experiences a temporary setback, you never truly know, and that's why you can regret owning stocks, especially single stocks that don't have a wide moat around them. But there doesn't have to be a dot-com bubble or global financial crisis to lose money in the stock market and regret holding individual stocks. There has been several popular stocks that have suffered losses and never fully recovered. Some of the notable examples include Eastman Kodak. KODK was a ticker symbol. Kodak was once a leading manufacturer of cameras and photographic equipment. However, the company struggled to adapt to the digital age and filed for bankruptcy in 2012. While the company has since emerged from bankruptcy and it is still in business, its stock has never fully recovered. Number 2 is General Electric. General Electric was once one of the largest and most diversified companies in the world with interest in a range of industries including energy, aviation, and healthcare. However, the company's stock has struggled in recent years due to a variety of factors, including accounting issues, weak earnings, and a large debt load. In 2021, the stock was trading for a fraction of its pre-2008 financial crisis levels. Number 3 is Sears Holdings. Now, Sears was once a retail powerhouse with a massive network of department stores and a popular catalog business. However, the company struggled to adapt to the rise of e-commerce, which Amazon took full advantage of, and Sears had to file for bankruptcy in 2018. While the company is still in business under new ownership, its stock has never fully recovered. Had you invested in GE at the beginning of 2005, the stock was trading at around $35 per share, and by the end of 2015, it was trading at around $30 per share. That means over a decade, you lost $5. But that's just how much money you lost gross in nominal terms. If you factor in inflation, you also missed out on approximately $30 going to $37.50, assuming an average inflation of 2.1% over that 10-year period. So you really lost $5 and another $7.50 roughly to inflation. But owning a stock that tanks and never recovers is even worse if you compare it to an alternative like investing in an index fund like the S&P 500. From January 2005 to December 2015, the S&P 500 index had a cumulative return of approximately 72%, or an annual return of approximately 5.3%. This means that if you had invested in an S&P 500 index fund at the beginning of 2005 and held it until 2015, your investment would have grown by 72%, including reinvested dividends. And that's why stock market investing in individual stocks can make you seriously regret your decision. Many people think stocks are a way to grow your wealth quickly. This could be further from the truth. To start with, investing in the stock market is not a guaranteed way to make money. Despite what some might believe, it's probably a good idea to realize that you're most likely not going to be the next Warren Buffett who can beat the stock market consistently. While it may seem easy to make money when there are favorable market conditions, the truth is that the chances of getting better than the average are so small that 90% of actively managed funds fail to outperform the S&P 500 over a 15-year period. In the short term, you may see some outliers, but even the funds that do beat the market still have investors within them that wind up losing money. A perfect example of this is the Magellan Fund, which was the world's best-known mutual fund and had record-setting growth under management of Peter Lynch from 1977 to 1990. Despite their incredible success, having outperformed the market for over 15 years by a long shot, it was reported that the average investor lost money during a period of time where the fund returned around 29% annually. Why are investors so bad at investing? Well, during those years, there was some really good times and some really bad times. When the average investor bought in with excitement at the peak and then sold off their investments when everything lost money, they logged in their losses and missed out on all subsequent growth. Had they just held on and done nothing, they would have had made money. And that's why you are likely to regret owning stocks, because most investors holding stocks see bad results. Let's talk about a popular stock you wouldn't imagine could lose any money. Apple. A popular stock is typically one that is widely recognized and held by many investors, and is often a household name. When I think of a household name, it's Apple, since everyone has a mobile device. Well, if you invested $1,000 in Apple, it would surely be a good investment if you wait a year, right? Wrong. Apple's stock price has experienced significant growth over the years, but it has also suffered notable declines from its peak at different times. For example, in late 2018, Apple's stock price peaked around $233 per share. Over the following months, the stock price declined sharply, reaching a low of $142 per share in early 2019. This represents a decline of around 39% from its peak. Had you invested $1,000 in Apple in late 2018, in just a few months, you'd only have $610. Even worse, had you put $100,000 into Apple, you'd be down $39,000. It's worth noting that while Apple's stock price declined significantly from its 2018 peak, it has since recovered and has continued to perform well overall. As of April 2023, the stock is trading at around $154 per share, which is still lower than its 2018 peak, but represents a substantial recovery from its 2019 lows. The point is, Apple tricked many investors into buying it for over $200 per share because of its iconic brand name. But what if I told you that it's not just Apple that tricked investors to buy the shares for much more than they're actually worth? That's because almost every investor gets tricked by the market to sell low and buy high. This is a case of timing the market. It's a really important reminder that you should not be buying stocks if you're chasing returns and expecting above the average. Moreover, it's essential to understand that even though the stock market increases on average of 10% a year, actually getting 10% a year is incredibly rare. I know it's crazy because we're made to believe the stock market is this vehicle that can double our money and make us thousands of dollars a month, even if we have very little capital. But despite the advertisements, courses, gurus, and pretenders, the market functions based on physics and averages. The market has only returned between 8 to 12% in a year 5 times since 1926. 8 to 12% one-year returns happen just as often as the market going up 40% in a year. Not to mention, even more absurd is that only 18% of returns have been between 5% to 15% in any given year. And it's more common to see double-digit price increases or decreases than it is to get a return around the average. That's why it's generally suggested that if you're investing, you have to have an outlook of decades, not just years. If you view market returns from the lens of a 30-year period since 1926, the best return was 13.6%, while the worst was an 8% return from 1929 to 1958. Of course, there's no guarantee that the US market will do as well in the future as it did in the past. With inflation on the rise, owning physical assets like real estate could greatly outperform the stock market.